Hey, good morning, everyone. Marty Mazzori here. It is Tuesday, the 30th of January, 2024, with your midweek market snapshot. Clients, it'll come linked to an email tomorrow morning as Wednesday's morning note. This is a massive week for economic data releases. It's a big week because it's the Fed meeting, and it's a big week because it's the quarterly refunding announcement, which I wrote a little bit about in this morning's note. I said in Saturday's video that the QRA, the quarterly refunding announcement from the Treasury, might even be bigger news this week than the Fed meeting. And I say that because it was such big news during the November QRA. Janet Yellen really leaned toward the short end, which I actually think makes sense when we think about our intermediate term thesis about the prospects for the economy actually slowing and therefore rates coming down. And so, but borrowing on the short end essentially puts less upward pressure on long-term interest rates. Yesterday, and this is what I talked about briefly again in this morning's note. Let me just pull that over to give you a feel. So actually the big one's tomorrow when she announces, or when the Treasury announces the complexion, if you will, whether they're going to borrow more on the short end with bills or the long end with bonds again. But yesterday, actually, the announcement in terms of the amount that they anticipate, and by the way, they don't have to stick with this. They can issue a lot more if they need to. But when the Treasury announced $760 billion for this quarter, as opposed to the expected $816, I drew an arrow right here on the S&P 500 and its reaction to that. And you can see that that made for a pretty decent day yesterday, and that clearly was the catalyst. And clearly, in my view, and I think in the view of a lot of people, the Treasury is desperate not to roil markets much in 2024. And when we look at the Treasury's checking account, right? So this is the Treasury general account, right? It previously issued debt that now is sit there yet to be spent. So when you really beef up the Treasury general account, that's spending that you can actually do that you don't have to borrow to do, meaning you don't have to issue new debt to do it. So with $800 billion in their checking account and forecast less in terms of what they'd have to borrow to spend in the quarter. It's a good spot to be if you want to give the market what would be a bullish signal. So that's kind of what I expect tomorrow. What's interesting, though, is the market doesn't seem to be discounting much optimism right here. Alongside all this data that I'm talking about, and you got the jobs number on Friday as well, is some key tech earnings. I think 5 of the so-called Magnificent 7 this week, 2 after hours today. And as I speak, the NASDAQ 100 is actually down 82 basis points. So we'll talk about why that might be as well with some other data that came out today. So it'll be interesting to see. 5:30 in the morning, our time, which we're on the West Coast, we're going to get that QRA, that quarterly refunding announcement. And then at 11 a.m. our time, 2 p.m. Eastern time, the Fed announcement, and then the press conference after that. And I mentioned this also as well in the morning note. If the last press conference is any indication where I think the Fed did a massive about face in terms of their intentions going forward, that was a very bullish, dovish move that really helped, along with the QRA and a few other things, get that November-December rally of last year. So the Conference Board's consumer confidence survey results were released this morning. Remember, we already talked about the University of Michigan, that big jump there. Not quite perhaps as big a jump, at least doesn't look like it on the chart, but a pretty optimistic look from the Conference Board's consumer confidence survey, and I'll get into the details here in a second. And then the JOLTS, the Job Openings and Labor Turnover Report, came out this morning, and actually job openings, which have been trending lower, actually jumped a little bit. The market traded lower on the, certainly I noticed it on the JOLTS report. It may have on consumer confidence as well. Because remember, folks, the market seems to be far more worried, as it has been for quite some time, about what the Fed is going to do, what the trajectory for inflation and interest rates is, as opposed to what would otherwise be good news, right? Job openings going up, consumer confidence going up. If ultimately you want to invest on fundamentals, and I can almost promise you that, folks, we are going to live long enough to see fundamentals matter again, and that's going to have serious market implications when that time comes. But right now, it's almost like good fundamentals are bearish for stocks, because it could mean that the economy is going to hold up, and therefore inflation may stop going down, and maybe worse yet, will start going back up. And that would be quite the conundrum, quite the problem for the powers that be in 2024. And then notice, though, the quits rate is continuing to roll over. It looks like it was flat here month on month. And the quits rate is just, again, the extent to which people are quitting their jobs. When it's going up, that's bullish, because people don't quit unless they have something better in the offing. When it's going down, it says something negative about the state of the economy. And notice how these things lead, right? This purple line up here is the unemployment rate. And notice here, right, job openings rolling over, unemployment rising, quits rate rolling over, unemployment rising. The job openings rolling over, unemployment rising, quits rate rolling over, same thing. Here we are again. We actually had our recession light long before we knew about COVID, lit, so to speak. The Fed said other things while they were starting to juice the economy, so they obviously saw what us and others were seeing. And then you see the unemployment rate spike up. Of course, COVID just distorted all of this. But here we are again, folks. Okay, so job openings rolling over, notwithstanding this. And again, I've said it over and over again on the charts. People are talking about how strong this labor market is. Oh, we have no recession risk whatsoever, because look at how low unemployment is. Well, yeah, it is until it isn't, and this is like the last thing to go, as you've noticed here, before we go into recessions. And I show you this almost every week in the economic update when we look at weekly jobless claims. Okay, so with regard to some of the underlying details on consumer confidence, and I'm very grateful to Peter Bookvar, because he does such a good job of reading through all these things and giving us the important key highlights in the most objective fashion. So the Consumer Confidence Index from the Conference Board followed the University of Michigan, this green one here, direction of trend upward. The print of 114.8 was as forecasted and up from the 108 in December. That's the best level since December 2021, but still well below the February 2020 print of 132.6. Helping the present situation was an improvement in attitude toward the labor market. Interestingly, jobs were plentiful, rose to the highest level since June of 2023, and those hard to get, the lowest since March of 2022. On the other hand, expectations for employment fell to a 3-month low, as did income expectations. So there's some conflicting sentiment coming from the survey. Notwithstanding lower inflation expectations, and in contrast to what was seen in the University of Michigan survey, spending intentions actually declined for autos, homes, and major appliances from the previous month. Bottom line, January's increase likely reflected slower inflation, anticipation of lower interest rates ahead, and generally favorable employment conditions as companies continued to hoard labor. And hoarding labor means we're actually seeing, on a trend basis, job openings come down. So they're not offering positions as much, but they're not laying off a lot either. However, having said that, I keep hearing about, who was it? One of the Wall Street houses today announced a few thousand as well. It's almost every single day you can see companies are cutting. UPS just announced 12,000 as well. Okay, so on to markets. I can keep this quick, folks. I'm just showing you the same patterns, and they're not good patterns. It is interesting to me because S&P is just off a little bit, but the NASDAQ 100 is down 80 basis points, so 0.8%. And again, we have a Fed that was very friendly last time that's going to announce tomorrow. We have probably a very bullish quarterly refunding announcement coming tomorrow morning. That would be my guess. And we've got these tech earnings, so maybe there's some nervousness around tech earnings. Breadth, as I've said the last couple mornings, has been quite stinky, if you will. Okay, so just the daily on the S&P 500, folks, it's just the same thing. We have a rising wedge pattern against bearish divergences. So this highly suggests that odds favor the market rolling over here in the short run, or as opposed to barreling higher. But again, there's so much that could barrel this market higher, if you will, over the next few days. But, you know, at the same time, if it can do that, it can also send it in the other direction. Even on the short-term chart, here's your 60-minute chart. You have the market continuing to meander into or around all-time highs, and look at the divergences here. So even short-term, it says the market's set up for disappointment next couple of days. It would not be surprised to see these fail with all the potential for the market here. But again, that's potential in both directions. On the NASDAQ 100, they're same pattern, right? Momentum rolling over, not a good sign. Just coming off of overbought there on the 60-minute chart. Yeah, really ugly here, short term, and that's being reflected today. It's down a not small amount for one morning. And then just the daily on the Russell 2000. Now this one is the one that has looked the worst of the three that we've been tracking. It's actually the most constructive right now. You can see it just keeps pounding its head on this resistance that takes us back to February of last year, so about a year ago. I really tried to do it yesterday, closed above it, but failed. You don't want a failed breakout. You just have the most nascent buy signal here on the MACD. That's not a divergence. It's actually going up with price. This is just a little more constructive. I'm not really bullish on small caps. Small cap volatility has been elevated. It remains above 20, so that says that this is a risky place to be right now. But of the three, just right now, as we sit here today, this has gone from the least constructive to the most constructive for the bulls, but nothing I would get overly excited about just yet. And then quickly, because we do this every week, this is yields rolling over a bit. This may be anticipating, some weakness here, and maybe it's anticipating a somewhat dovish Fed and weak job numbers. We shall see. And then the dollar. Notice we had this consolidation that we broke out of. We were bullish right here. That played out. Remained pretty much here. I said we probably break out above that. We did. Now we're in this consolidation phase. The dollar is probably going to move with the prospects for interest rates based on the Fed, based on the QRA, based on the jobs numbers on Friday. So if the data come in weak, dollar's going lower. If it comes in strong, dollar's going higher. Higher dollar, higher yields on the previous one, bearish for the stock market. If the data is weaker, dollar goes down, yields go down, bullish for the stock market, notwithstanding what happens in the earnings announcements over the next few days. So, folks, I'm gonna do a hard stop right there. Again, clients, you'll get this in the morning, and then we'll do a written note on Thursday, and then end of week wrap on Friday, and then economic update over the weekend. It's going to be very interesting next few days. Folks, thank you as always for watching and listening, and I'll talk to you soon. Bye-bye.